Hey, Sean, thanks so much for joining me on the show.
Thanks for having me, Chad.
So, I always love talking to real estate investors, and you in particular will be very interesting to get your insight on because you guys own about 45 million square feet worth of industrial real estate.
Yes, we do. We have properties coast to coast, um, primarily in large metros. So we're everywhere from the coastal markets, whether it be the northeastern or California area, Seattle, as well as South Florida, which we consider coastal, to the growth markets primarily, and some assets in the Midwest. But we're in the major metros across the country.
And you made the decision around 2010 to focus exclusively on industrial real estate. And your portfolio looks like it consists primarily of logistics, warehouse, distribution space.
Exactly. We made the decision to be masters of one thing and the asset class that we liked most, which was industrial and a small subset of industrial, which today is called last mile. Then it was called infill industrial.
So, what was the decision at the time? Because industrial, that warehouse last mile delivery has become a lot more popular in the last couple of years, but you were well ahead of your time, going back 12, 13 years now to identify that as a growth area. What did you see at that time that looked so appealing?
Well, frankly, Chad, that's where we were best and we made the most money. That's really what it came down to. And it was also during a time of the GFC, the Great Recession, where we were looking at what asset class had the most longevity and the most broad-based demand drivers, and that was industrial. And if you were close to the population, whether it be close to decision makers who had their facilities close to their homes or near the workforce or near major ports or rail, there were always different drivers. So even as industry shifted, because e-commerce wasn't a thing then, there was demand for the product, and your costs to re-tenant and your capex was far less than other asset classes. And we'd experienced that, given that we owned other asset classes like office, for example. And for all those reasons, I mean, industrial for us was the best fit, and it turned out to be a good call.
Yeah, that understatement right there. It's been a fantastic call for you guys on the way to grow into 45 million square feet worth of inventory. And you touched on it a little bit on how you chose areas. But when you're looking at a specific market, are you looking at opportunities first, or are you identifying a market and saying, this is just where we want to be? Let's go and see what's available.
Well, what we look at, we have our own proprietary call it scoring system that we use, Z-score. And so what we look at first and foremost is which markets do we want to be in? And we will select those markets based on a long list of different variables, including what is the population growth rates and the existing population density there, proliferation of industrial throughout the market. Really, we look at things on a more macro level on certain cases. And today, I mean, we know exactly which markets we want to be in. Some want to be in more than less. And then what we do is we look at a given market, and through our scoring system, we determine what are the best locations for last mile within those markets. And then our teams on the ground find the actual assets that meet our property criteria within those little subsections of a market that are ideal for last mile.
Yeah, interesting on that. And I know that you just closed on a property in Texas, so congrats on that one. And you're also doing a development in Florida. So I'm assuming that you're bullish on both Texas and Florida as markets.
Yes, I would say the most recent developments or most recent deals that we've closed on, I don't know if there's been PR or not on them, but they've been in Seattle, in California, multiple locations, and Florida as well. So, we're very bullish on certain markets today, given the economy and given our ability to source what I think are some of the best deals I've seen in 10 years. We're more focused on what we call the coastal markets, which are your top tier markets, some that are top tier in the world, frankly, from a logistics standpoint, and select very high, call it high barrier to entry growth markets. So examples to that could be Nashville, certain Florida areas, Austin, and a select few other markets that we're really targeting today. Although, I mean, as you look at our portfolio, we're all over the place, but our focus shifts based on the economy as well, and based on our ability to, what we believe is, find some of the best real estate today, which have the most lasting values from a location standpoint. And so if we could pick it up now and we otherwise couldn't in the past, then we're going to do that.
Yeah, on that point as well, on trying to identify trends and what's happening, these past few years have been very unpredictable and volatile, not just in the real estate markets, but in the capital markets and the global economy. So it's very difficult to try and put a finger on the pulse of what's actually happening. But where do you see the market right now, maybe from just like a macro level, on the strength of the industrial market, the prospects of that continuing to grow for the foreseeable future?
I mean, that's a lot of questions in one, but we're very bullish on industrial in general. The economy, in my mind, is going to have a correction. It's just inevitable. Economies always have corrections, and we've been in a bull market for quite some time, and so it's about time for that. And for us, we've made the most money during those corrections, and so we look forward to finding opportunities. I do believe in the tailwinds in industrial. I think something that people forget is that even if sales decline, and I believe they will overall, and consumer demand as inflation grows will also decline, if your, for example, logistics costs or your transport costs, which you being in Alberta are well familiar with, given as energy goes up, the costs to deliver goods go up as well. And so the higher those costs go, the more important the real estate to distribute those goods is. Because if you're not right next to your consumers, you simply can't profit in a world today where we expect the goods, either the same day or soon thereafter. And so what we foresee is happening is, in the future, today, given, we're not a merchant builder, but we're a significant developer. I mean, we have roughly 18 million feet in development right now at some point, some stage. We perceive there to be a stopping of development for the most part throughout the country. And you have that because of cap rate shifts, interest rate shifts, and all those things. And then what happens? What happens, and we saw it in COVID, is that you can't flip a switch and build more industrial. I mean, today it takes longer to build product than it ever did. And so what happens is that even when there's a lull in the economy, as soon as things stabilize, even if they're stabilizing lower, companies recognize they really need this space more than anything else, because real estate itself is your smallest component of your logistics costs. It's at 3 to 6%. And so you need that real estate in order to reduce your other components, whether they be labor or transport. And so what we perceive is happening is that over the next coming years, as the market resets, development has pretty much ceased in most of the country, at least new projects, and that is going to get eaten up. And then what happens to your rental rates? They will be driven up substantially. And companies can afford to pay higher rental rates if, by leasing that space, they're reducing their more significant costs, which are the transport of goods or the access to the labor force. And so, in summation, what we believe to happen is there will be a correction. However, in the medium to long-term, industrial will be the beneficiary of that correction, because your lease rates will grow substantially given there's not going to be as much product to fill the need for industrial as there was in the past. Today, Chad, in the US, even with a reduction of roughly 10 to 15% of overall demand for industrial, there isn't sufficient industrial product to keep up with 5 years worth of demand.
So that explains why you're so bullish on industrial on that. And just going back to that one comment that you made is that even if there is an economic pullback, you guys have been very successful in times like that. Is that just a result of seizing opportunities where other people might be timid or scared?
Yeah, it's several things. One, we've historically been very patient in deployment of our capital, and we've seized opportunities as we found them. But we also look at things on a more granular basis. So if you look at, generally speaking, industrial within the U.S., unlike other asset classes, or unlike Canada, for example, Canada is actually a great, contrasting ownership structure to the US. In Canada, most of the industrial, as you probably know, is owned by institutions. The majority of it, the high quality industrial. In the US, it's only roughly 30% institutionally owned. And so that means the majority of the stuff is owned by smaller local owners, owner operators, regional developers, etc. And the product that we've targeted historically and continue to target are more of, we select the best buildings in the best locations on a one-off basis, and we build a portfolio. Because if you look at the institutional side, if you own good industrial, you're not in a distressed position today, and you don't have to sell. And therefore, a lot of institutions will simply choose to not sell any product. And so if you have the infrastructure, as we do, and the understanding of where you want to be within markets, and you can target individual properties, we believe that you'll find better deals than you've ever found in the past. Because people, unlike institutions and funds, have very different motivations often for trading product. And they are, much more susceptible to market shifts in terms of their need for cash, whether it be to run their business or, they're passing on assets to a family member, whatever the case may be, there's more opportunities there. And because of the way we're set up, I believe we'll be able to find those opportunities.
Yeah, that was very well said on that. And that leads me naturally to the next question that I had is you're bullish for the long term. You've identified your proprietary system of selecting markets. So once you've selected a market, you've determined you want to deploy some capital, then you've got to start identifying the properties. And you mentioned best in class is what you want to target. So it's difficult to answer in one or two sentences, but what are some of the key things that you're looking for in a Class A property? Or if it's easier to answer, what makes a Class A industrial property?
It's a very good question, Chad. For the most part, for us, we look to buy properties that are newer. Depreciation is not simply a tax calculation. Your properties get less valuable with age. And so the younger the portfolio we can have, the better for us it is to retain the value and to call it attract the best tenants. So what does a Class A property look like? In today's world, if we're going to build over, call it 300,000 feet, we're at a minimum of 36 clear. We're going to have, speed bays. We'll have, a large amount of doors. We'll have substantial amount of trailer parking. And I'm not going to give you all the different figures because they actually differ dependent on the market and your availability of land there and all kinds of other attributes. But in general, Class A properties have your most modern specs from an industrial standpoint. And that means that a tenant can go and load their goods and offload their goods very easily. And they have the ingress and egress that they need. They have the clear heights they need to maximize storage and utilize laser robotics as they need, as some companies do, and automation in there. They have the speed bays that are necessary for the movement of goods in and out of the facilities. They have that trailer storage, which is really critical. Trailer storage today and parking is the new clear height in many respects as it relates to e-commerce. And so that's what a Class A will look like, a modern property that is built to modern specifications. In certain markets, like coastal markets, for example, where land is very difficult to come by and most of the product is older, a great example of that is like the northern New Jersey markets, exit 8A, all the other exits there that are servicing the, call it, New York metro area and the whole Northeast corridor for that matter. The product is older, and so you're going to have to sacrifice on your quality of building from a Class A standpoint. And so what we look for in those properties is what is the most functional building that we can buy, and what is, number one, the best located building. Because what we've seen is that if you are ideally located and you have many of the specifications, maybe you're not 36 or 40 clear, but you're 24 clear, you have ESFR sprinklers, and you have sufficient loading for trucks to come in and out, and you're very close to the highways, you'll command the highest rent, probably much higher than your most modern buildings in the majority of the markets. And that's what happens if you're buying infill like we do. So sometimes we have to sacrifice on the vintage and quality of the building if it means that we are in an irreplaceable location with high barriers to entry.
Is there any component or attribute of a building that is non-negotiable for you that you wouldn't make the sacrifice in an older property?
I want to say yes, and I will say yes, because if I look back and look at our portfolio is relatively modern, probably, although don't quote me on this, but I think it's probably roughly in the mid-2000s, our average build. And so it is a very, modern portfolio given, our scope of ownership. But there are certain things that we won't do. And that is if properties have 14 clear, stuff like that, if they have virtually no loading, you have truck courts of 75 feet, you have smaller tenant sizes, those are the things we just don't do. It's just not the business that we're in. And so sometimes that's meant, Chad, is that we've had to sacrifice on really great locations because we felt that the configurations of the buildings were such that we just couldn't fix them. Mm-hmm. And yes, they were unbelievably well located, but we would rather invest our capital in assets that we feel would attract the best tenants. And there's certain attributes like your clear heights, your configurations of your buildings, and your construction type that you simply can't fix.
So what on a spectrum of value add investing to buying a property that already has existing cash flow in there and you're just becoming a cash flow investor, that older industrial stock starts getting into that realm where, like you mentioned, there might be lower ceiling heights or bad marshalling area, and you might be able to work around that, or you might even physically be able to raise the roof in some situations. But it comes with a lot of cost, it comes with a lot of uncertainty, it comes with a lot of time that goes with it. Would you say that just as a result of your strategy, you're more towards the value add on trying to perhaps repurpose a building, get a new tenant in there, as opposed to like that straight value add on trying to retrofit an older property?
Chad, we define value add in many different ways, and we are by nature a value investor. And so what does value add mean for us? Well, here's some of the things. It can mean buying a property in many infill areas that has been largely converted to office, but the clear heights remain very good in the property. Your loading is good, except your loading doors have now been, glassed over, their windows. And so that's a very easy fix for us. What we'll look at is how do we retrofit these suites to bring them back to their true industrial nature, and say bring back the office to 10% versus the 75 or 100% that it might have been. And so that's one easy fix. Other things that we look at is we often buy properties that were owned by local owners who are owning properties that what for them is most important is the cash flow. As I'm sure you know, at NOI, a lot of people who own the buildings, they just care about, they don't want to put any money in, they just want to collect that mailbox money. And so what we'll do in these cases is we will come in and do the necessary improvements to these buildings. And these improvements can simply be very basic, but they can be painting the buildings, resurfacing the truck core, stripe and seal the parking, etc. And we will convert those tenants over to the rents that are really market rents. So a great example is in South Florida or the Miami area. The majority of buildings over the past several decades have been owned by really high net worth individuals. And it was a trend within that market to have gross leases. Gross leases is really not something that we have in the industrial world, at least in the Class A industrial world. But Miami had that. And so I remember we went out and bought several buildings in the Miami area. And the first thing we said we're going to do is we don't care what our neighbors are doing. For us, we're going to have net leases. And given what we believe is the lack of product and the attractiveness of the spaces that we had, we felt that even if tenants weren't comfortable paying it and they had to leave, a new tenant would come and take that space immediately and pay us net rents that were market rents. And in this case, we were setting a lot of the market rents. And it worked. And it worked because we understood that the market itself was converting from being largely individually owned to institutionally owned. And once that happens, all the rents are going to shift to net. So that's something that we do. Another thing that we do is we will buy a property that, for example, in certain markets like the Inland Empire, I'll give a recent deal that we're buying right now. It's 2 Class A buildings that were developed in the Inland Empire. And because of the lack of space and the sub 1% vacancy that they have in the market, these properties got built up got leased up right at the beginning of their construction. And so what that meant was between now and between then and now, the rents in this case had increased by over 50%. And so now the owner had a property with locked-in rents at 50% of the market. They were Class A buildings that were newly developed, which was unique in this particular submarket of the Inland Empire, where it's very difficult to develop. And we knew that upon these tenants rolling, we were going to be able to more than double the rents, conservatively speaking. And so we were able to buy properties at a very low basis on a price per foot, knowing that the value was going to come in applying the hands-on ownership that we do and increase those rents. And so that's something else that we do. Another thing that we do is we buy properties granularly. So what does that mean? Our traditional deal, Chad, is under 35 million. And so if you look at what we did last year, we did over 2.1 billion in deals. And it's a significant amount of buying. And if you're buying deals at under 35 million, in many cases under 10 million, that's a lot of transactions. And so you have to have the infrastructure and the boots on the ground and the team to be able to do that velocity. And most companies simply don't have that. If you look at the biggest buyers of industrial, they're buying portfolios, because to be able to buy one property at a time is just too burdensome. It takes as much effort to diligence a $1 billion deal as it might to do a $25 million deal. So where do they want to focus their efforts? And so what we've made our, call it niche, is in cherry picking the best properties, buying them one at a time. And when we put them together, what we have is an institutionally cherry picked portfolio of scale that immediately commands value from a cap rate compression standpoint. Because a big institution can then come buy this portfolio at a much reduced cap rate than we're paying for an individual building, because we've done all the work in putting it together.
Yeah, that's a very intriguing notion, and I love that comment that you made, that you're able to get that cap rate compression because you've done the work. You've done that value add of finding each one of these individual properties, which an institutional buyer values and would be willing to pay for. On the topic of cap rates and closely correlated with interest rates, are you seeing any noticeable change in cap rates as we see upward pressure on interest rates?
It's a difficult question to answer because there haven't been many trades, at least in our world. The large portfolios that were being marketed, including from ourselves, were largely pulled off the market because we didn't need to sell certain things. And, Blackstone, Hillwood, many others that KKR, et cetera, all pulled their portfolios from the market. And so you didn't have those trades take place because they didn't need to sell. And why sell into a market where your debt's upside down in many cases? And so do I believe that cap rates will increase? Yes. Have we seen some cap rate increases on the individual deals we're buying? Absolutely. But it's not enough that I can say it's a market trend. I think the world is getting used to a new normal. And that new normal is, for now, interest rates will continue to rise. And we anticipate that being, unfortunately, a longer term thing. When or if it will eventually go back down, we do believe it will. I don't know, but I can tell you that what we've seen is far less trades. And you can see the impact also in the lending world. And the impact is severalfold. In your debt funds, well, your debt fund lenders have had a lot of their lines frozen. And so that inhibited their ability to lend. They've also been margin called to a degree. And so it put their cost of capital at higher. You've had the CMBS world completely freeze up, or especially for the larger transactions, what is called the SASB world, which is the single asset, single borrower world in the CMBS universe, which are securitized deals for those who don't know. Those are mortgages that end up getting cut up and sold as bonds. If you look at Blackstone, they were probably the biggest borrower on the SASB in the SASB world, and that's all their largest deals they would finance in that way. Well, the market has pretty much seized up, and although it's come back to a limited degree, the rates are much higher, and so that's no longer available. You've had banks which have had banner years because of their ability to put out money, who are now not in a position to want to risk anything, and so they'd rather be very conservative and give you lower leverage deals. In what we've found is lots of lenders, if you don't have existing relationships with them, you're not going to get loans. We thankfully, with the capital markets team we have in place and the great work that they do, we have wonderful relationships. We were even able to get loans in March of 2020 and in thereafter. I mean, even in the height of COVID, we were able to get loans done because, frankly, there were many banks who wanted to do business with us who weren't able to do so earlier. And they found that as an opportunity to get in there and be able to lend money to a very strong borrower who does a lot of deals and, most importantly, pays back their loans. And so we were able to benefit from that, but not everyone is. And so you have that, and you have a record number of call it non-refinancings of properties, if that's even a word. But banks aren't getting paid back because people aren't selling the assets and they're not refinancing the assets right now. And so they have less money to deploy because they're unable to recycle anything. So you have that perfect storm happening. And because of that, it's very difficult to make a determination as to what cap rates really are. But I do believe that, I know that's a long answer, but there's so many different variables that go into that. And anybody who tells you cap rates have gone up, I don't believe, because there really haven't been any trades that are of significance and of consistency to show that trend.
Yeah, I agree completely. And that was very well said. I would agree on the standpoint that for industrial property owners, unless they were forced to sell, and perhaps it's that small mom and pop owner that just needs to get rid of a property for whatever reason, they might sell into the open market and have to perhaps take a loss if there's a little bit of interest rate threat right now. But for anyone that has a longer term tenant in there, you just ride this storm out and you don't even worry about these short term aberrations. But with this rising interest rate environment for those smaller investors that are trying to get capital, they're coming up against that spread on how much revenue is coming into the property and then what their debt servicing is going to be. Are you seeing a trend towards, and it could be larger or smaller investors, floating their debt for some period of time until we perhaps see some downward trend on interest rates? Or is still a model of fixing your interest rate so you at least know what your costs are going to be?
Probably different than Canada, because I know, given that I'm Canadian as well, and did a lot of business in Canada, and we still have an office in Montreal. What we've found, Chad, is that most fund investors, including ourselves, will borrow on a floating rate basis. That's just par for the course always, or for the past number of years. And the reason being for that is because you can't be opportunistic about the way you do business if you have prepayment penalties, or in the CMBS world, defeasance, which is, for those listeners who aren't familiar, you have to pay the bank or the lender a certain amount of money to break that loan and to be able to sell the property, which becomes cost prohibitive. So it may cost you a substantial amount to pay the bank in order to be able to sell that property and get out of that loan. And for us, we want to do what's best for the property at the most opportune time. And the only way to do that is by having debt that doesn't have these prepayment penalties. Mm-hmm. And so we've always been a floating rate borrower. With that said, we cover our butts by doing things like having well over north of 90% of our portfolio with caps in place. So we're buying caps, and in certain cases, unique cases, we'll buy swaps as well. But most of the time, we're buying caps, and so we're mitigating our interest rate exposure by doing that. You have the open-ended funds, the REITs, and the those borrowers who were borrowing fixed rate. And what we found today is the big difference between borrowing today and borrowing yesterday is the bigger the loan, the more problems you're going to have. I can tell you that any loan over 50 million of proceeds that you're requiring probably needs to be syndicated, which means you have to find other banks to partner with the lead bank to do that loan. We've had to syndicate the loan for the banks in many cases, meaning our capital markets team has had to find several different banks who all wanted a piece of a given deal, but weren't willing to take the whole thing down and put them together in order to get the deal done. And that takes a certain level of sophistication. In the past, the banks used to do that themselves, but today, given times and given the effort it takes to do that, if we're doing it, we want to find the banks that we know would be taking that exposure and be willing to do it. And that's very hard to do. So I can tell you we're seeing transactions happen that are smaller than ever before. And that's a paradigm shift. Any big deal is pretty much not getting done unless the buyers are all cash. They're still out there, the all cash buyers. On the smaller end, you probably have some 1031 buyers. But on the larger end, it's mostly the sovereign wealth funds who will maybe provide some level of internal financing, but predominantly don't care. They're just going to go all cash. So I don't recall that ever being the case, maybe during the GFC at some points, but I mean, it's just difficult to borrow big deals. So what we've had to do is, for example, we have a $200 million portfolio of assets we've put together on the West Coast for one of our funds. And we've determined that we're just going to simply break it up into three. We would have never done that before because we would have got better terms if we financed it as a whole. And so that's the difference we're seeing today.
Yeah, it really underscores how complex it gets at your level versus an owner that perhaps has a small business and they want to go buy their own industrial property and they look at a 10,000 square foot warehouse building. They might just go and talk to their lender that they have their business line of credit with, and that's who arranges the mortgage. But once you start getting into your level and you're having to syndicate different banks to get multiple banks involved in the financing, I can certainly appreciate how much more complex that gets. I want to shift to the tenant side, and this we could wrap up with here because I'm very conscious of your time, and I don't want to take take too much of it. But on the tenant side, I think what we're hearing a lot lately, particularly in mainstream media, which just loves this sensationalism, they love throwing things out there just to get clicks. And every time Amazon speaks, it seems they make the front page of the Wall Street Journal. If they say that they're going to give up one warehouse, that makes the headline, even though it might be buried down saying that Amazon's going to take 10 other warehouses in the same area. The news that gets made is that Amazon is giving back one warehouse, and that seems to create a little bit of a murmur in the community of people saying, well, could this be the top of the real estate market? Are these companies going to start giving back space, or even perhaps defaulting on some of these leases? Are you concerned about this current state of the environment, or is it just more noise?
Again, a very good question, Chad. I can tell you, as it relates to Amazon, it has been noise in large part. And I'll give you one example. We were actually been on both sides of this, being that there is one property that Amazon wanted to vacate that they had a lease with us. And we were so happy that they wanted to get out, because that means we were able to get a higher lease rate from somebody else. And so in this particular case, they were paying roughly $875 a foot on the property, and or in the given space. And we ended up leasing it to a tenant paying $1150 for the same space. So that was wonderful for us. And another case is, here was Amazon giving this headline about that they were getting out of these spaces, but yet they were negotiating with us on multiple different other locations that we have to lease our space. And so we felt that it was noise. But we have to remember one thing. Amazon is one company. And although they have made up, at least from a company standpoint, the largest tenant in the industry, they have been at the forefront of the last mile hunt, right? They have been able to recognize way before everyone else that if you're not next to those consumers, you can't profit, and you simply can't get them the goods quickly. Everyone else is playing catch up. And so those tenants are trying to catch up. And we haven't yet seen any slowdown in lease rates or in leasing velocity throughout the country. We have seen dramatic rental rate growth, dramatic. And, you know, we've heard a lot of headlines, but we just haven't seen the impact yet. And again, it's going to be the barbell effect, meaning in certain cases, like in your infill properties, which we focus on, the ones near within key city centers and next to key distribution hubs, whether they be ports or rail, etc. If you have heavy barriers to entry, even if the market is declining, you're still going to see that lease rate growth, because you simply have a sub 1 or 2% vacancy rate, and there's nothing available for tenants as they want to come in. And so we haven't, in large part, seen anything yet. Do I believe in certain markets with certain spaces? Dallas and Atlanta are examples that there'll be softness in that leasing market. Absolutely. Absolutely, there'll be softness. When you can build a lot and it becomes a commodity to put up these buildings, as the market tightens from a demand standpoint, or call it softens from a demand standpoint, you're going to have lease rate decline and you're going to have more vacancy. And so we anticipate that happening, but we just haven't seen it yet. If you look at our numbers, we're pro-formaing that happening. We're pro-forming, in many cases, flattening of the lease rates and limited growth at all. And yet we're seeing the opposite, which is great. But we do anticipate that eventually to happen in sub-markets. But I can tell you, as you've alluded to, it's been a lot of noise. There have been great sound bites. Amazon, gets rid of 10 million feet. They had a portfolio of over 400 million. Like, what is that saying? It's nothing. So they're getting rid of 10 million feet. I mean, it's a rounding error.
Yeah, well said on that. You said that way better than I possibly could have, and I think that kind of leads into the last question that I have for you to end on, and I think anybody that's listening to this will probably be able to piece it all together. But I'd like you to summarize where you think the industrial market is right now. What and fully recognizing nobody has a crystal ball, but everybody still needs to make pro formas, like you said, and everybody still needs to have some sort of plan on what could happen in the next, call it 1 year to all the way up to 10 years. So it just with however you want to end and conclude with, where do you see industrial real estate right now, fall of 2022? Where do you see it next year? And in very long term, where do you see it in 10 years?
You're right. I don't have a crystal ball. And this may come back to haunt me as other things I've said, but given that we look at the fundamentals, Chad, we like to see ourselves as the house more than the gambler here. And so from our standpoint, and I won't say me because we have very smart people, much smarter than me in our firm, who help us come up with these strategies and form our opinions. We believe that today in 2022, your best asset class to own is industrial. In 2023, your best asset class to own will be industrial. In 10 years from now, your best asset class to own will be industrial. Why? Because unlike multifamily, which is the next best asset class, you have corporations paying your rents. And if cost of living continues to go up, eventually you reach a certain point where you simply can't charge people more for their rent because they can't afford it. You can't have mass defaults of leases. Where are these people going to live? I'll tell you something. Politicians typically don't get involved when companies have to pay double the rent they had to pay before. But they very well will get involved when their voting base is getting evicted from their buildings. And so what we believe is that the key drivers for industrial not only are strong today, but will continue to strengthen. You look at the proliferation of e-commerce. If today it's at 15% of retail sales, I don't perceive us ordering less goods in the future. We're only ordering more. And so what does that look like when it's 25% of retail sales? You're going to need more industrial. You also have something that happened as a result of COVID and logistics issues, which is just in case inventory. You're seeing it with retailers today in the headlines. You had the Walmarts, the Targets, the everyone's of the world, all the biggest companies have these massive orders of goods they had to take that they couldn't fill. And so 2 years later, they're getting in the patio furniture that somebody ordered, 2 years before, and they no longer want that patio furniture. So they're having to liquidate those goods. So what they're recognizing is, even if they're getting those goods more cheaply made, if they don't have those goods able to deliver to the consumers when the consumers want them, they take great risk in the value of those goods going down, and the call it viability of their businesses, frankly. And so they need more goods just in case, which means you need more warehouse space to hold those goods. You also have something that hasn't happened before, and that's coming from geopolitical risk, etc. And that is nearshoring and onshoring. Nearshoring and onshoring, well, what does that mean? A lot of the goods that were made in Asia, maybe they were much more efficient at making the goods and, of course, far cheaper. But if Shenzhen is closed as a result of a COVID lockdown, your product's not being made or shipped out there. And so how are you going to get the goods to your consumers? So you have to find alternative means in order to produce those goods, which takes away from the call it risk of those goods not being available when you need them most. And we're seeing it, especially as it relates to your chips, the chip shortage. I mean, it's all coming from one place predominantly. And so from Taiwan. And so you need chip manufacturing facilities here domestically. You need more heavy manufacturing here domestically. Why? Because companies need to be able to have those goods just in case, because they can't be 100% reliant on getting their goods from overseas. And so what that means is you need more industrial. You also have manufacturers now selling directly to consumers. In the past, that was never the case. There are companies today, very large ones, who are manufacturing goods and then selling those goods on every conceivable marketplace, meaning Facebook Marketplace, Shopify, Amazon, and all the others, eBay, individual products that in the past they would have sold to your local Sears or O'Reilly's Auto Parts or whoever. Now they can ship them directly to the consumer. So what does that mean? That means these manufacturers are now beholden to the fact that if they're not close to those consumers, they can't profit in shipping that individual unit. And so again, more demand for the space. And so from all those things, from the increase in manufacturing, the needing of goods now, the increase of e-commerce, the onshoring and nearshoring, you name it, all those different things, they're all big boosts for industrial. And I can tell you one thing that's happening today more than I've ever seen it in the past, and that's something called NIMBYism. I don't know if you've heard it, not in my backyard. We've been refused for 3 projects recently from a development standpoint on stuff that was effectively in 100% industrial areas. That's highest and best use was industrial, and that in 2 cases was predominantly zoned industrial, and in the city's master plan was industrial. Why was the stuff, why were these assets call it these projects refused by the city councils? Because people went and protested. We had one case in Florida, in Miami, where we had 1,000 people, over 1,000 people, literally. There were so many people, they couldn't fit them in the facility, protesting one of our developments, which of course, at least in the iteration that it was in, didn't go through. And so what does that mean? That means even though the demand of industrial will continue to increase, people don't want to live next to industrial buildings, and they don't want to think that they're going to have to see big trucks all over the road near them. So as much as everybody wants their goods now, they just don't want those goods to be coming from a facility that's next door to them. And so again, that's going to increase your demand for or your value of industrial product, because it's going to be harder and harder to build. So in short, I think we are in the best asset class. The long-term viability of our space is, I think any institutional investor or economist will tell you, the best asset class to both preserve equity and grow equity is highly likely industrial, because of it's the demand drivers and the fact that we just need more industrial space, and we simply don't have it. And so for all those reasons, I'm very bullish on our space. I think whatever happens in the short term, you can't predict, Chad. But we don't invest based on what's going to happen tomorrow, because we don't know. Why we've done very well over the years and made our investors a lot of money and been able to really grow to one of the dominant buyers in the country is by recognizing that you have to take that longer term approach, buy the best real estate in the best locations at the best prices. And you have to have the people in place to find those deals, and then the teams in place to operate them to institutional standards. If you do that, you're going to do very well in the long term. So I'm irrespective of what happens in the market on a given day, I know we're in the best asset class.
I love everything you said there. There's so much insight and wisdom there. I'm glad not only that we had a chance to talk, but I'm glad that we recorded this, because I'm going to go back and listen to this again after. I just loved everything you had to say there.
Well, I'm grateful that you invited me, and anytime.
Awesome. Well, thanks again. I really do appreciate your time. I'll send you a copy of this once we have it all finished as well. And I really do appreciate you taking the time to do this.
Anytime, and Chad, if you find yourself in Dallas, I'm happy to sit down with you anytime and grab lunch. It'd be great to hook up with a fellow Canadian.
Absolutely. I look forward to it.
Take care, bud.
Okay. Thanks, Sean.